Can Guyana's oil boom become a long-term success? South America's oil landscape is defined by the contrasting paths of Brazil and Venezuela, a dynamic that frames the rise of Guyana offshore oil. While both countries possess vast hydrocarbon resources, their outcomes reflect sharply different approaches to governance and development. Venezuela once stood as the region's dominant energy power. By the 1970s and 1980s, it ranked among the world's leading exporters, supported by reserves in the Orinoco Belt and around Lake Maracaibo. With proven reserves exceeding 300 billion barrels, its resource base remains among the largest globally. Yet political mismanagement, chronic underinvestment, and sanctions led to a sustained collapse. Production fell from more than 3 million barrels per day in the late 1990s to below 1 million barrels per day, as infrastructure deteriorated and operational capacity weakened. As a result, Venezuela's global position declined sharply. Fields were left idle, skilled workers exited the sector, and PDVSA's reputation shifted from technical strength to inefficiency and governance failure. This contraction reduced both export revenues and geopolitical influence. Brazil, by contrast, followed a path of steady expansion driven by offshore innovation. The discovery of deep-water pre-salt reserves in the early 2000s transformed its role in global energy markets. Fields such as Lula and Zeus, though technically complex, unlocked large-scale production potential. To develop these resources, Petrobras advanced deep-water capabilities, enabling output to reach around 3.5 million barrels per day. This made Brazil the largest producer in South America and a significant global supplier. Over time, efficiency gains reduced costs and strengthened the viability of offshore operations. Following this progress, Brazil expanded its investment framework. Opening pre-salt blocks to international companies brought in capital and expertise, accelerating development and diversifying the sector beyond a single operator. This contrast leads directly to the role of governance. Venezuela's policy environment constrained investment and weakened institutional stability, while Brazil created conditions that supported long-term growth and technological advancement. The result is a clear divergence between contraction and expansion. Across the region, these outcomes have reshaped trade flows and market roles. Venezuela's decline reduced supply to traditional markets, while Brazil's growth strengthened its position as a reliable exporter, particularly to Asia. This duality defines the context for Guyana offshore oil. Resource potential alone does not determine success. Institutional strength and strategic execution remain decisive. The central question is whether emerging production can follow a path of stability and growth rather than repeating patterns of decline. Guyana's trajectory is being reshaped by the rise of Guyana offshore oil, set against a history defined by colonial legacy, migration, and structural constraints. Since independence in 1966 and its transition to a republic in 1970, economic development has been limited by political fragmentation and reliance on exports such as gold, bauxite, rice, and sugar. For decades, this narrow base placed Guyana among the poorest countries in the Western Hemisphere. That pattern shifted rapidly with offshore discoveries, positioning the country within a new energy frontier. Backed by billions in foreign investment, Guyana offshore oil has driven double-digit GDP growth in recent years, marking one of the fastest expansions globally for a population of just over 800,000. As a result, the economic landscape is changing at speed. Urban development in Georgetown is accelerating, supported by expanding ports, service bases, and infrastructure upgrades. Roads, bridges, and digital systems are being modernized, while inflation and labor shortages reflect the strain of rapid transformation. This challenge leads directly to the management of oil revenues. Funds are being channeled into a sovereign wealth framework designed to ensure transparency and long-term stability. Investment priorities include healthcare, education, renewable energy, and coastal protection, though institutional capacity remains under pressure. Following this expansion, foreign investment has become central to the development of Guyana offshore oil. International firms across logistics, engineering, and finance have established a presence, supported by regional partnerships that provide technical expertise. Broader economic effects are visible in rising real estate demand, increased air connectivity, and expanding technical education. The central issue now is whether this momentum can be sustained. Guyana offshore oil has created the conditions for a rapid shift from economic periphery to regional significance. Yet long-term outcomes depend on effective governance, capacity building, and political stability. The development of Guyana offshore oil is centered on the Stabroek Block, a license area of roughly 26,800 square kilometers. It is operated by ExxonMobil Guyana Limited with a 45% stake, alongside Hess Corporation with 30% and China National Offshore Oil Corporation with 25%, forming the core consortium driving offshore expansion. The breakthrough came in 2015 with the Liza-1 discovery, located about 200 kilometers offshore. The well identified more than 90 meters of high-quality sandstone reservoirs, confirming significant resource potential. Since then, more than 30 discoveries have been made within the block, establishing a highly productive offshore province. As a result, development moved quickly into production. Liza Phase 1 began operations in December 2019, followed by Liza Phase 2, Payara, and Prosperity. These projects are supported by FPSO vessels, including Liza Destiny, Liza Unity, and Prosperity, enabling continuous offshore processing and export. This expansion leads directly to rising capacity. The Yellowtail development, the fourth major FPSO, adds significant storage of up to 2 million barrels and increases output potential. Combined with existing infrastructure, production has moved above 600,000 barrels per day, with targets of around 1.3 million barrels per day by 2027 as projects such as Whiptail and Uaru are developed. Guyana offshore oil has moved from discovery to large-scale production, supported by major international operators, advanced offshore infrastructure, and a rapidly growing resource base. As additional projects reach full capacity, both output and economic impact are set to increase further. The expansion of Guyana offshore oil is unfolding alongside a range of economic, technical, and security risks that could disrupt its trajectory. Rapid growth is placing pressure on systems that are still developing, creating tension between opportunity and capacity. At the economic level, the windfall is arriving faster than it can be absorbed. Local content rules aim to direct value to domestic firms and workers, yet limited capacity and evolving compliance systems raise the risk of bottlenecks, cost inflation, and benefits leaking abroad. While the 2021 Local Content Act formalized targets and reporting, building a strong supply chain and skills base will take time. This challenge leads directly to macroeconomic exposure. Reliance on oil revenues is increasing before diversification and energy reform are fully in place. Delays to the gas-to-energy project at Wales, along with disruptions linked to offshore pipeline tie-ins, have already affected operations. Prolonged setbacks would weaken competitiveness beyond the oil sector and heighten fiscal volatility. Technical risk is also concentrated. Production depends on a small number of FPSOs, making reliability critical. Gas compression failures and flaring at Liza exposed vulnerabilities in key systems, showing how single-point failures can lead to output losses and regulatory pressure. From an HSE perspective, spill liability, insurance, and emergency response remain under scrutiny. Any major incident would test containment and cross-border response systems in a region with sensitive coastlines, making enforcement and preparedness essential. Security risk has moved closer to the forefront. Venezuela's renewed claim over the Essequibo and maritime activity near offshore assets have increased tension. Even without escalation, this pressure raises insurance costs, complicates logistics, and adds uncertainty to investment conditions. These risks are interconnected. Delays in energy infrastructure can intensify economic strain just as local content expectations rise, while geopolitical pressure increases operating costs. Conversely, reliable FPSO performance, Visible HSE discipline and timely infrastructure delivery would strengthen the impact of Guyana offshore oil. The trajectory now depends on execution under pressure. Guyana's offshore assets operate at the intersection of reliability, HSE discipline, and geopolitical risk. Preventing single-point failures on FPSOs requires redundancy, rigorous maintenance, and effective gas management. This challenge leads directly to strengthening risk controls. Spill response and insurance frameworks must be reinforced, while maritime security depends on layered surveillance, coordinated patrols, and clear protocols with partners. Following this, infrastructure execution becomes critical. Advancing gas to energy reduces flaring and public risk, while transparent oversight supports institutional stability and credibility. For Guyana offshore oil, long-term value depends on visible safety performance and credible deterrence. Without these, rising costs, higher premiums, and political risk will erode the gains of the current boom.